By a long shot, housing affordability has been the largest problem in the US housing market over the past few years. It's the number one reason why people can't buy a home, simply because it's too unaffordable. The prices don't make sense with the interest rates combined with people's income. But there is an emerging problem in the housing market as well. It's not just that housing is too unaffordable, but a lot of people are starting to see their mortgage applications get denied. Especially since 2023 and forward, we've seen more and more mortgage applications being denied. Now, the mortgage application denial rate varies by state, but there are a few states in particular that are seeing very high rates of mortgage application denials over the past couple of years. Most notably, states like Mississippi. They are at the top of the list with 19% of all mortgage applications being denied since 2023. And Louisiana saw 18% of all mortgage applications denied. And in West Virginia, it was a whopping 15% of mortgage applications denied. And by the way, in case you haven't noticed, I'm shooting inside today because we got a massive thunderstorm outside. So not much we can do about it there. Now, what is the reason for this? Why is this happening? Well, there are a few reasons, and these are big reasons of why people typically get denied for any type of credit, including a mortgage. And it's why I talk to people so much on the channel about getting out of debt and keeping your finances in order and making sure that you are making sufficient income compared to the money you are spending. Because people are getting denied for things like insufficient credit or a change in credit score, meaning that you just don't have enough credit history, or your credit score is going down because you maybe made too many credit applications recently, or maybe you're not paying your bills on time. There's also increased debt, which means that you have a higher debt to income ratio, and the more debt you carry versus your income, then the lower chances you're going to get approved for any type of loan, including a mortgage. There's also low income. You need to have a solid income to be able to buy a home. No lender is going to give anybody a mortgage if your income is too low. Now, the rejection rates on loans tend to be higher for jumbo loans and non-conventional loans. And that's not really a huge surprise, because people who are getting a jumbo loan are typically trying to buy a very expensive house. You're talking a home that is well over $800,000 in many cases. So the lender is really going to scrutinize and make sure that you actually can afford to buy that house. And when it comes to non-conventional loans, these are loans that people typically don't fall into a certain box to qualify. Like, this is somebody who maybe is self-employed and can't prove the proper amount of income, or because their credit is bad, they're applying for a non-conventional loan. So of course you're going to see the denial rates higher. Now, one thing that they try to say here is, well, people who are black or Hispanic or Asian are seeing higher denial rates than white applicants, which might be true, but in reality, you have to look at it like, even if that is true, the underlying reason of why they're being denied has nothing to do with their race. It's because of the insufficient credit. It's because of the low income. It's because of a bad credit score, or missed payments, or too high debt to income ratio. So they try to paint the picture that this is a race issue, that people are being denied a mortgage based on the color of their skin or whatever. But the reality is, half the time these days, you don't even meet your lender in person. People do things online. People make mortgage applications online. You might not ever even meet this person. They're going to have no idea what race you are, but they are going to know your income. They are going to know if you've paid your bills on time. Those are all things that count, not your race. So yeah, maybe people who are in these races have lower credit scores and have more financial issues, but that just means that you need to work on that. It doesn't mean anything else, guys. In fact, I got an email from one of my viewers who is a regular viewer of my channel and some other channels here on YouTube that talk a lot about debt. And this was a great success story, because he wrote me saying, you know what? He was in debt for a long time. He says that he actually worked really hard to get out of debt, and he would have cleared it up sooner, but he got into legal trouble back in 2024, so it got pushed back. But what he did is he cut back on his expenses tremendously. He also grinded hard, working extra in order to pay off the debt. He kept his expenses low since the beginning of last year. And he even started eating one meal a day at the end of November last year, which he said helped a lot in order to cut down on his budget. He said in the month of December, he only took 2 days off, so he was just working as much as he could. And now his debt is clear, and he's keeping his budget on lockdown and keeping his expenses low. He says he still has a low amount of emergency savings, but he's working on that. And once he feels like he's got some breathing room with his finances and his emergency fund is bigger, he's going to start investing into a Roth IRA. And honestly, that's how it's done. You need to focus like that. You need to work hard for a while. You need to cut back on expenses for a while. And then once you do get out of debt, you're never going to want to go back, because once you reach that point, it's like a big burden, a big weight has been lifted off your shoulders, and all of a sudden you have this extra money each month, and now you can save it or invest it towards your future, or even, put it towards that down payment for your next future home that you want to buy. That's a tremendous achievement, So congratulations to you, Rebel Montana, and thanks for sending me that story. I'm really happy to hear that you got out of debt, and hopefully anybody else that needs to hear something like that can get some inspiration from you. Now here's something interesting in real estate, okay? There is a landlord in Las Vegas who is now suing his tenant over a $180,000 Airbnb fine, okay? For 2 years, this landlord rented this house out to a tenant, and when the tenant moved out, the landlord was hit with a $180,000 fine from the city, and what it was basically 2 years of an illegal Airbnb operation. So now the landlord is suing the tenant to try and get this money back, and also for additional fines and damages. And so what this tenant was doing was something called Airbnb arbitrage. I actually have a good friend that does this, and what it is you rent out a place, and with the landlord's permission, you actually are able to sublease that place on Airbnb. And this tenant claims that he had 7 houses in Las Vegas at the time that he was doing Airbnb arbitrage, and the whole time the landlord knew that he was doing Airbnb, and now he's claiming that he had no clue, and that's why he's suing him for the fines. Now, first of all, I think this is kind of wrong in the sense that the city slaps the owner with the fine, right? The owner wasn't living there. Like, if the owner of the property can prove, like, hey, I wasn't living at this property, I had it leased out during this time, I wasn't the one who was doing Airbnb, you can check the listing, it was the tenant, that fine should go to the tenant. There's no reason why they should be fining the owner of this property for something that he didn't even do. Now, yeah, you could say it's negligence. You could say that he allowed them to do that even though it was against the law or whatever in exchange for maybe higher rent. That's usually the deal that a lot of people that do Airbnb arbitrage do. But even then, you're not the one doing it, guys. So in reality, it should be the person who is actually responsible for racking up those fines who should be responsible for paying them, which is why the landlord has to sue. But the city should be slapping those fines on the person who was doing it to begin with. And they are really cracking down on Airbnb. Apparently in Las Vegas, they have fines ranging anywhere from $55,000 as high as $240,000, which just sounds kind of absurd, but I guess they have to make it extremely high to make it, prohibitive so people don't do it, right? Because people can lose their properties over these type of fines. That's a huge amount of debt. You get slapped with that, and if the city or the county puts a lien on your property for that much, it could be game over for you. And apparently the short-term rental laws in Las Vegas are so strict now, where basically they have it that if you are going to rent out your property on Airbnb, number one, you as the host need to stay at the property. So you cannot just rent it to somebody else and you leave. You have to be there while the person is renting it from you on Airbnb, and that property needs to be at least 660 feet away from another rental. So you can't basically have one right next door. They won't allow it. And what happened is a lot of neighbors started making complaints about the rental, and residents complained of an overflow of cars being parked in the driveway and said that the activity at the house was regularly disturbing the neighbors and the peace and quiet. So that can be a problem too. If they were just operating it normal and nothing was happening like that, if there wasn't a party house, and they probably would have been able to get away with it. But once the neighbors start complaining, that's it. Your cover has been blown. But the landlord in this case actually has a valid point too, because he's claiming that, Airbnb should have required proof from the tenant that he was properly licensed to rent out the house. And because Airbnb didn't do that, the landlord is also seeking damages from Airbnb as well, which is true. Like, if you're going to create a platform and you're going to allow people to put their properties up there, then that platform needs to comply with the local laws and regulation. It's up to you, the platform, to make sure that you have all those local regulations and laws up to date every single day, that goes by, because otherwise you're the one who's also enabling the situation. It's your platform that's making this possible. If it wasn't for Airbnb, this person wouldn't be able to even get away with doing this to begin with, right? So it's going to be interesting to see who actually comes out on top. The problem is, like, you read these stories and they come out, but you never hear the follow-up. You never hear what actually ended up happening. And I don't know if we'll get a follow-up on this story, but I think it's interesting to say the least, because it gives people a couple of real world lessons here. Like, number one, if you're a landlord, it's probably best to never let your tenant sublet. That should always be checked. No, in the lease, don't agree to a higher rental amount because they're going to do Airbnb arbitrage, especially if you're unaware of the local rules and regulations. It's one thing if you know for sure if the property is allowed to do short-term rentals and you know it's not going to be an issue, then sure, why not? Collect the extra rent, let somebody else deal with the headache. But in this case, where the laws are pretty clear that you're not allowed to do it and there are a lot of restrictions, it was stupid for the landlord to agree to let the tenant do this, although the landlord claims he never agreed to anything and the tenant says he knew about it. So who knows? It's also a case of he said, she said, and no one's going to really know until the lawsuit shakes out. But also, if you're somebody who's doing Airbnb arbitrage, or even if you're not really doing it on that level, like say you rent an apartment and you're going to go out of town for a few months and you want to rent it out. If you do that without your landlord's permission and you do some sort of Airbnb situation like this and there are fines or fees that get racked up like this, you could be on the hook like this tenant might potentially be. So you never want to do anything like this without your landlord's permission or without knowing what the local laws and regulations surrounding short-term rentals are. Now, the next thing is homeowners insurance, guys. Homeowners are really becoming more and more frustrated with home insurance because, the rates keep going up and the deductibles keep going up and the coverage is going down. And you have a lot more homeowners now who are basically taking on a larger and larger responsibility in terms of the dollar amounts that they're responsible for when it comes to insuring their homes, because homeowners last year in 2024 that took on a mortgage had deductibles that were 19% higher than those of the average mortgage holder, and they ended up with premiums that were 12% lower. So you could say, oh, that's great, they're saving a little bit of money on homeowners insurance, but their deductible is a lot higher. And the reality is homeowners insurance just continues to skyrocket for a lot of people. In fact, in 2024, the average homeowners insurance premium for single family homes was recorded at a record high of $2,290 according to ICE, which is the Intercontinental Exchange Report, and that was up from 14% just a year ago. And so you can tell by looking at this chart here just how much this continues to climb. And so far, there is no slowdown in sight. We'll see what happens with 2025, but it's already not looking good. We've seen a lot of reports and a lot of stories, especially out of Florida and California, where these insurance companies are requesting increased rates because of all of the natural disasters and things that have been happening. But if you look back on this chart, back to 2015 where it goes, insurance rates were relatively stable from 2015 through 2020 and even went down a hair in 2016. So yeah, there were small increases from year to year back then, but we're talking $50, not $200 and $276 where it's going now. And those are just the averages, and these numbers are still cheap if you ask me, especially if you live in Florida, because most people here are not paying $2,300 a year in homeowners insurance. It's a lot more in many cases. In fact, homeowners here in Miami are seeing the highest average insurance premium for single family homes with a mortgage in 2024 at $6,200 per year, and New Orleans is actually next on the list at an average of $5,700 per year. And by the way, quick side story on this, this is one of the reasons that I keep telling people that even though we're having this big condo crisis here in Florida and people are selling these condos because they're expensive to maintain now, big special assessments, big increases in the HOA fees, a lot of people say, oh, well, they're just going to run to a house. Well, look at that, guys, $6,200 per year here in Miami, and probably a lot of other areas in South Florida as well. You're going to see similar rates, and that's just the average. Okay, so talk about special assessments. That's a huge special assessment you're getting every year just to be able to live in your own house, and you don't even know how much it's going to be next year. So if you think you're just going to run away from problems at a condo and move into a house here in South Florida, you are sorely mistaken. You're going to have to move a lot further away from South Florida, maybe to a different state or another part of Florida where prices are not as insane as here, because, switching from a condo to a house in Miami is likely not going to save you any money under the current circumstances, by the way. Now, it is paying off for some people who are switching carriers, because on average, the person who switched last year in 2024 is paying about 10% less, so that's not bad, but it's coming at a cost. And that higher cost is people paying a higher deductible on their homeowner's insurance. So people are thinking, I can switch my policy, right, and I'm going to save an average 10% on my premiums, and then I'll take on a higher deductible, which has been about 19% higher in 2024, and through those combination of things, I'm going to save more money on my homeowner's insurance. Well, that works, and it's also fine to do as long as you know you're going to have the money to meet your deductible, because a deductible is basically the amount of money that a homeowner has to pay before the insurance company steps in to pay for a claim. And the higher deductibles, the lower your premiums, because chances are you're going to have to pay for the lion's share of any damage that comes from whatever happens to your house. And the thing is, with homeowners insurance, it's different than like health insurance. Health insurance, you have your maximum out-of-pocket deductible for the year, and once you reach that limit for the year, then your health insurance picks up 100% of your costs. But with homeowners insurance, it doesn't work like that. With homeowners insurance, your deductible is per claim. It's on a per claim basis. So say you have 2 problems with your roof in 1 year and your deductible is $15,000, you're going to be responsible for the first $15,000 of damages and repairs both times in that same year, regardless of whatever happened, if you're even covered on top of that. Now, I think this could be a good strategy if you have a lot of money and you're thinking of going without insurance anyways, but you're able to get that premium down low enough where you're actually in a situation like, okay, this isn't crazy, I'll pay for this, and in case of something catastrophic, at least I still have some coverage. So if you're somebody who is thinking about going bare anyways and you don't have a mortgage, this might be a good strategy. But for the average person trying to save a little bit of money, maybe not. Although at the same time, we've covered many different times here on the channel how homeowners insurance will not cover you for so many different things. And we saw a huge scam, especially here in Florida last year with the hurricanes. People were seeing their payouts far, far below what they were promised to be by the insurance companies, because what was happening is they would get a quote from an adjuster that would come out and see the property and say, hey, there's $200,000 worth of damage here. That quote would then get sent over to the insurance company, and a desk adjuster at the insurance company who never saw the property would look at that quote and just basically cross out that $200,000 and say, we're going to pay $30,000, maybe even less than that. And then it's up to the homeowner to actually fight that in court and sue the insurance company, which can take a long time, which is very expensive to do. And so these insurance companies are essentially betting on the fact that if they do this to enough people, most people aren't going to have the will or the finances to fight back. They're just going to have to, take it up the you-know-what and essentially just accept whatever they're willing to pay. And that's that. And unfortunately, a lot of people end up doing that because it's not worth it for them to fight. They just can't. They don't have the money, the resources, the time. They just need to get the house repaired. They're living in the house. It's not, just an investment property or a second home or whatever. This is their home. But the other thing to look at here with this is the fact that one of the best pieces of advice that was given to me by an insurance agent here in Florida is that you basically never want to make a claim on your homeowner's insurance, especially because the moment you do, even if you call in to ask questions about a potential problem or whatever, that will be recorded and potentially treated like a claim. And anytime you make a claim, you are kind of like blacklisted in a way that you are now looked at as a higher risk. You are going to be harder to insure and more expensive to insure anytime you make a claim. And it's basically a guarantee that your insurance rates are going to go up if you do. So yeah, you have the insurance, but if you make a claim, you are essentially going to be punished for making that claim. That is a guarantee. So the rule of thumb is with homeowners insurance is you have it but you never want to use it. And that means that if you go down this road of having a higher deductible and a lower premium, could actually work out into your favor because, hey, the insurance company isn't going to cover this anyways, and as long as you have some finances saved up and there is a problem and you have that 15 or 30 grand laying around that you might need in case of an emergency, then it's not a bad strategy, because then you're going to keep your insurance premiums low, you're never going to end up making that claim, and maybe eventually if you end up paying off your mortgage, you can just drop your insurance altogether, which a lot of people are doing. Now, Wells Fargo came out this week and talked about how home sales aren't far from the levels that we saw during the Great Recession, guys. And, you know, we've talked about how slow home sales have been for a while here now on the channel. Basically, home sales are at 30-year lows. But in January of 2025, total home sales came in at an annualized rate about 4.7 million, and we just haven't seen that basically since the housing market was in a full-on crash. And I'm not saying that the housing market's in a full-on crash right now, but we are seeing some similar data points referenced from that time period, most notably the home sales being as low as they are. And think about it like this, like before the pandemic, home sales were annualizing anywhere between 5.5 to 6 million homes sold. So we are far below what the average amount is for home sales each year. And that's just, you know, what the annualized rate is right now in January. That can drop even further as home sales continue to deteriorate throughout the year, because there is really no sign that things are going to get better or improve anytime soon throughout the rest of this year. And they say right away here, well, we can't blame this on a recession because there's no recession. It really just comes down to affordability, which I think is partially true. I'm not going to agree and say there's no recession. I think we are in a recession, but a lot of the data that proves we're in a recession has been masked for quite some time, and only a lot of it now is starting to kind of creep up and come out more and more. However, I do believe that if home prices fell far enough under the conditions we're in right now, then we would see home sales resurge. But home prices would have to fall at least 30% for that to happen, at least. Which is why they're saying that I wouldn't be expecting a meaningful improvement in, you know, the housing market over the next couple of years, they're saying here. So we could just be kind of stuck in this lull of a housing market for the foreseeable future, guys, because something's going to have to break. Something's going to have to change. I've talked about this many times. We need to see mortgage rates come crashing down. We need to see people making far more money, or we need to see home prices come crashing down, or some sort of balance of all three of those things happen in order for buyers to return back to the market in a meaningful way. Because all these people who are buying right now are basically wealthy. We're talking people that earn well over 6 figures a year, that money's not really an issue. That's why you're seeing the prices of these homes that are being sold are really going up, and that influences the median home price throughout the year. Because if you're having the majority of the homes that are selling, you know, being over the $500,000 mark, well, of course median home prices are going to be going up throughout the country because more expensive homes are selling, and that pushes the median home price higher. But that doesn't mean that every house in America is now automatically worth more because wealthy people are paying more for more expensive homes. That's something that I think a lot of people struggle with and don't really understand about real estate, because everything is so local. Like, just because, you know, some rich guy in Miami or California or whatever is paying $5 million for some waterfront house doesn't make your house in Nebraska that's $350,000 automatically worth $500,000, you know? It doesn't work like that. But if you're in Nebraska and you're a $350,000 house and you see a bunch of your neighbors selling the houses for $425,000 or more, well then yeah, the value of your house is going up, and now your house is probably worth that $425,000 just like your neighbors. It's all based on comparable sales. You have to look at what is selling in your neighborhood and for how much, and how similar is that house to my house, and that truly determines the value of your house. Not what these median home prices say, not what the Case-Shiller home price index says. None of that stuff really matters when you look at it on a local level and what your house is worth. And that kind of goes back to what I was saying at the beginning of this video. You know, a lot of people are being denied for mortgages, right? And if you want to have a shot at being able to buy a house one day, you need to get your finances in order. You need to make sure you're out of debt. You need to make sure you are increasing your income while decreasing your debt. That's going to give you a better chance of being approved for a mortgage. That's going to give you a better chance of even being able to afford a house under the current circumstances at all. So those are all things that are going to help people, and the faster everybody starts doing that, then the further ahead you're going to be able to push your financial life forward. So I hope this video helped you, and if you enjoyed it, please make sure you are subscribed to the channel by clicking the button down below. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.